India today presents a baffling economic paradox. While the nation's internal economic engine is firing on all cylinders with a robust 7.4% GDP growth, the Indian rupee is telling a different, more somber story. Since April 2025, the INR has slid by 6%. In this analysis, based on the insights of C. Rangarajan and N.R. Banumurthy, we investigate why a booming economy is paired with a sliding currency, identify the geopolitical villain behind the curtain, and outline why the solution lies in Washington, not Mumbai. To understand the gravity of the situation, we must look at the thesis. The rupee's decline is not a standard economic correction. It is a symptom of geopolitical fear. Domestic fundamentals remain rock solid, featuring that 7.4% growth and a remarkably low inflation rate of 1.33%. Yet, we are seeing massive capital outflows totaling nearly $4 billion. This isn't about trade deficits, it's about a 50% US tariff duty and a hostile foreign policy environment. Standard monetary interventions are no longer enough. We need a structural diplomatic fix. If you look at our health gauges, everything is in the green. GDP is high, inflation is actually below the RBI's lower target band, and the current account deficit has significantly improved to 0.76%. By every rule in the economic textbook, the rupee should be strengthening. However, as we see in this decoupling chart, the historical correlation between economic health and currency value has shattered. Since April 2025, the lines have diverged. The market is shaken not by what is happening inside India, but by the uncertainty looming outside. Many analysts point to the trade deficit, which rose to $96.58 billion this year. But the data shows this increase is marginal. It is not the smoking gun, large enough to trigger a crisis of this magnitude. The real villain is the reversal in capital flows. In late 2024, India saw $10.6 billion in inflows. By the same period in 2025, that swung to a $3.9 billion outflow. That is a staggering $14 billion swing. This money isn't leaving because Indian businesses are failing, it is fleeing due to investor fear. What is driving that fear? We call it the Trump effect. US trade policy has been weaponized through a tiered tariff system. It started with a 25% reciprocal tariff, followed by an additional 25% penalty for Russian oil imports, bringing the total duty to 50%. Now, there is a looming threat of another 25% for trading with Iran. Even though trade with Iran is a minuscule 0.15% of our total trade, the sheer diplomatic hostility is dominating market sentiment and crushing the rupee. It is vital to distinguish this from the decline of 2022. Back then, the rupee dropped 10%, but the driver was rational. The US Federal Reserve was hiking interest rates. It was an economic arena issue. The 2025 decline is different. There is no clear economic explanation. It is driven by diplomatic hostility and fear. We have moved from the realm of math to the realm of geopolitics. Many ask, why doesn't the Reserve Bank of India just stop the fall? It's important to understand the RBI's mandate. Since 1993, India has used a market-determined exchange rate. The RBI acts as a damper on a spring. It reduces volatility, but it does not peg the price. They are effectively letting the currency slide smoothly to its natural floor to minimize economic shock, but they cannot, and will not, alter the fundamental direction set by massive capital flight. Some might argue that a cheaper rupee helps exports, but in this environment that is a trap. Because of the 50% US tariffs, our exports are blocked regardless of the currency price. There is no export boost. Meanwhile, the cost of essential imports like oil, which makes up 25% of our imports, skyrockets, leading to imported inflation. Furthermore, with India's inflation at 1.33%, there is no inflation parity gap with the West to justify a correction. If we artificially devalued the rupee further, we would likely be labeled as currency manipulators. We must act now because the full structural impact of these tariffs won't even hit until 2026-2027. We are currently in a vicious cycle of fear-based volatility. The conclusion is clear. We have reached an economic stalemate. Months of negotiation have yielded no agreement, yet a US-India trade treaty is the only lever left that can actually appreciate the rupee. To summarize, the economy is strong, but the currency is a casualty of geopolitical war. The RBI can smooth the pain, but it cannot cure the disease. To stop the capital flight and stabilize the rupee, India must break the diplomatic stalemate with the United States. The shield for this political weapon must be a political treaty.